It's worthy to note, too, Anthony, that it isn't just oil that we're talking about. Oil is particularly important. Many pundits point out the fact that 20% of the world's oil flows through the Persian Gulf. What they neglect to mention is between 40 and 50% of the world's export oil flows through the Straits of Hormuz. For takers in the eastern part of the Pacific Rim, particularly Korea, Japan, and China, this is a particularly critical source of crude oil. But the difficulty extends beyond oil. The biggest supplier of liquefied natural gas to the world is Qatar, and that is shut in. The world's largest supplier of liquid nitrogen and probably export nitrogenous fertilizers is also in the Gulf. 30% of the world's supply of helium is in the Gulf. About 25% of the world's capacity for refining aluminum is in the Gulf. Perhaps 50% of the world's export supplies of sulfur and sulfuric acid are in the Gulf. So the circumstance that we talk about is important in the oil business, but it isn't limited to oil. And investors and speculators across a wide variety of industries need to pay attention to this. The potential impact, if the war goes on in industries as diverse as petroleum refining and shipping, could be dramatic. I'm not suggesting that the war will go on. I'm not a geopolitical analyst. I'm not a military analyst. I'm really, uh, I'm really a credit analyst.
Hey everyone, my name is Anthony Fatsis and welcome to another episode of the What the Finance podcast. On this episode, I have the pleasure of welcoming back Rick Rule. So Rick is the former president and CEO of Sprott US Holdings with decades of experience in the commodities business. He's also the proprietor of Rural Investment Media and co-founder of Battle Bank. So Rick, thanks so much for coming back on the podcast.
Anthony, thank you for having me back. I enjoy these sessions.
Yeah, really looking forward to the conversation. As we were saying before, it's been a pretty hectic start to the year with basically every single commodity having extreme volatility, which is can be good and bad depending on when you took a position. But where I'd like to start is the most recent volatility we've seen in the Middle East and I guess the impact that's had on energy. So how are you currently sort of tracking, and let's be honest, this interview is going to go up tomorrow, so probably things may have completely changed by then. But how are you tracking this, and how do you actually analyze the impact this is having on energy markets and your investment?
The oil stocks have given me 3 years of performance in 6 months, which is a bit disconcerting. I have not yet begun to reduce my positions in the oil stocks, but people who are traders need very much to consider doing this. Exxon was easy to love at 95. It's much less easy to love at 180 or 185. People need to understand that, particularly the gamier oil stocks. People need to pay attention to their own portfolios. I bought the oil stocks because of deferred sustaining capital investments. The industry is underinvesting in sustaining capital to the tune of between $1 billion and $2 a day. That figure likely has gone up very recently as a consequence of deferred sustaining capital investments in the Middle East, which would be dangerous to make right now. These deferred sustaining capital investments impact the industry's ability to produce 2 years from now, 3 years from now, 4 years from now. And the production is difficult to bring back online, which means that in 2029, 2030, it's likely that we, as a consequence of unbalanced supply versus demand, ration by price, and the prices go up. That circumstance, I believe, would lead markets to go up in 2027, 2028. Instead, the markets went up in 2026. If there is a reasonably timely, peaceful or semi-peaceful resolution in the Gulf, then the oil quotes come down and the oil stocks come crashing down. They will go back up, make no mistake, towards the end of this decade. But people need to decide whether they want to lock in sure gains now or whether they want to play the game over the next 2 to 3 years. It's worthy to note, too, Anthony, that it isn't just oil that we're talking about. Oil is particularly important. Many pundits point out the fact that 20% of the world's oil flows through the Persian Gulf. What they neglect to mention is between 40 and 50% of the world's export oil flows through the Straits of Hormuz. For takers in the eastern part of the Pacific Rim, particularly Korea, Japan, and China, this is a particularly critical source of crude oil. But the difficulty extends beyond oil. The biggest supplier of liquefied natural gas to the world is Qatar, and that is shut in. The world's largest supplier of liquid nitrogen and probably export nitrogenous fertilizers is also in the Gulf. 30% of the world's supply of helium is in the Gulf. About 25% of the world's capacity for refining aluminum is in the Gulf. Perhaps 50% of the world's export supplies of sulfur and sulfuric acid are in the Gulf. So the circumstance that we talk about is important in the oil business, but it isn't limited to oil. And investors and speculators across a wide variety of industries need to pay attention to this. The potential impact, if the war goes on in industries as diverse as petroleum refining and shipping, could be dramatic. I'm not suggesting that the war will go on. I'm not a geopolitical analyst. I'm not a military analyst. I'm really, uh, I'm really a credit analyst.
Yeah, super interesting. And I was listening to a interview earlier, and they were talking about how it would be the worst shock if this continues, oil shock, basically in history, if this continues, because currently, as you said, 20 million barrels flow through the Strait of Hormuz, but that actually already there's been 4 million barrels of production that has been stopped because the inventories and a lot of those Gulf countries are sort of getting full, and they want to slow down the production, because if you stop it completely, it then takes sort of weeks and months to actually come back online. So if the current conflict were to continue for a couple of weeks, that would basically bring the off production of at least 12 million barrels a day. That then would take quite a while to come online if this was resolved. So it does seem to be quite a unique situation.
I think that's the case. The Saudis are perhaps in the best shape of anybody to weather the storm, given the fact that they do have a pipeline that goes from their east coast to the west coast at Yanbu. And they do have the ability to reroute as much as 4 million barrels a day that currently goes through the Straits of Hormuz into the Red Sea. For other producers, Iran, Iraq, at least that portion of Iraqi oil that doesn't go north through Kurdistan into Turkey, and particularly Kuwait, this is an ugly circumstance.
Yeah, definitely. And it's been quite interesting. You mentioned that oil stocks have gone up quite a lot, but actually during this situation, they haven't really moved that much. A lot of their increases happened over the last 6 months, where oil prices and energy prices were actually coming down. So it's been quite an interesting disconnect. And now maybe the price is actually sort of aligning more with where the value of these stocks are.
Well, that's interesting. The oil price is just, from my viewpoint, too volatile to speculate. I'm not saying that the market is incorrect. The market responds to changes in perceived supply and demand, really, truly in real time, perhaps greater than real time. It's very difficult uh, to time or price that if you aren't in possession of lots and lots and lots of data. I'm an investor, not a speculator. And I notice that the increase, even as you suggest in the oil stocks going back in the 3 to 6 months time frame, has given me the gains in my oil stock portfolio that I had expected to have by the end of 2027. And it's an interesting conundrum. I feel very comfortable owning the oil stocks for the balance of this decade. For people whose orientation is more short term than mine, or people who entered the trade later than me, they need to decide whether or not they want to lock in these gains or they don't. Make no mistake, we if humankind resolves this conflict in the near term, however it gets resolved, uh, the oil quote falls back into the low 60s, maybe even the high 50s, and the implied premium in the oil stocks evaporates temporarily. Make no mistake either, however, that this hiatus and this deferral of sustaining capital investments will impact the supply of oil, and it will impact the supply of oil this decade. If somebody wants illustrations of that, all they need to do is look at the state-controlled firms in Venezuela and Mexico, PDVSA and Pemex, respectively. These countries have had their national oil companies defer sustaining capital investments for as much as 20 years, often ironically in favor of politically expedient domestic programs like subsidizing gasoline and kerosene prices. The consequence of which is that PDVSA, as an example, has seen its productive capabilities fall by 85%, despite having the largest oil reserves in the world. Mexican production has similarly declined, although not to such a great extent. When you defer sustaining capital investments, it doesn't necessarily have an impact in 6 months or 12 months or even 18 months. But over time, it has a really dramatic impact. And that impact can't be turned around, as you suggest, Anthony, in months. It takes years.
Yeah, and I think this analyst was saying that in every other situation, as you said, the Venezuela reappropriation, the Gulf War, the 1970s crisis, production is always lower and it has never actually reached the highs that it was at. So that's the hope that, if this doesn't continue and then production, doesn't come back to where we need it to be. Because even though there is a surplus at the moment, in the long term, that's going to evaporate.
Correct.
Yeah. And how do you deal with markets like this, where, as you said, you actually get quite a large increase and maybe close to, I guess, your current targets earlier than you expect? Do you then look to take profits, or I know you've mentioned that if the trend is still going and if the actual current cycle is still going, then you'll hold on, or how do you do that?
I'm not of a mood to reduce my Exxon holdings. I'm considering my Chevron and my Occidental holdings, whether or not to trim some. I should be trimming my basket of Canadian stocks. They've given me an awful lot very quickly. I haven't done so. Perhaps it's procrastination. And if I had a large basket of speculative stocks, I should be trimming those. Instead, I'm adding to them. There is one class of oil stocks that continues to be roundly hated. Those stocks are smaller microcap stocks, less than 300 million market cap, that are involved in conventional exploration rather than basin-centric or shale development plays, mostly in deep water offshore and mostly in emerging and frontier markets. The strategist in me says I should probably be taking profits on all of my oil stocks. The tactician in me is continuing to deploy capital in the one unloved corner of the hydrocarbon world, which is microcap, offshore, third world, emerging market explorers. I'm, as you know, a risk courter. If I'm confronted with asymmetric risk to reward parameters.
Yeah, okay, that's really interesting to hear. Thanks for explaining that. So, another commodity or commodities that have sort of had quite a lot of volatility are the metals, and especially at the start of the year, there's been a shift. I guess there's how would you explain that sort of the price action we've seen in the metals this year?
I think there's been a realization that almost irrespective of what we do, as an example in the copper business, that we're going to experience supply shortages. In the very, very near term, however, speculators betting on that are running into financing and carrying costs. So the copper market in the very, very near term is grossly oversupplied, and it's a catastrophe zone for speculators. Looking long term, 5 years or more, there's no doubt in my mind that we're going to experience a shortage of copper. So the outlook really depends on how you're playing the game, how much leverage you're using, and what your time preference is. I had the good fortune to attend Metals Week in London late 2025, and I heard one talk that really startled me. That talk centered around the fact that the major copper producers in the world have estimated that it will cost them 250 billion in constant 2025 dollars to maintain current production levels. The problem with that is that they're missing 100 billion of the 250 billion, and current production is at a deficit, which means just to maintain the current deficit rather than allow the deficit to grow, they need to invest $250 billion. And that ignores the fact that demand for copper on a global basis is growing by 2% compounded. What that tells me is that absent a global depression, that we will have such an imbalance of supply and demand in copper in the 5-year time frame, certainly in the 10-year time frame, that the only way to balance supply and demand will be by price, which tells me, again, in the out years, the value of very large tier one producing copper mines, that is to say, reserve life more than 25 years, where the mine doesn't need to be permitted or financed because it's already built and producing, that we are greatly underestimating the value of these mines. The difficulty with this thesis is that many people who understand the strategy don't easily wrap their heads around the fact that it will take 3 years or 5 years for this to mature. Most people understand the 5-year outlook, but they have a 3-month timeline for stocks. For those people, they need to ignore the copper story.
Yeah, and so a copper cycle is just a lot longer than other commodities because, as you said, the actual time to bring on production is, takes 10, 15, 20 years. So I imagine these cycles are just extremely long and, demand can have a massive impact, but there's just been so much underinvestment over the last 20 years.
The nice thing, Anthony, is that they're so predictable. As I've aged, uh, what I've learned is to prefer to ask myself investment questions where the answer begins with when, not if. Which is to say, I like to invest in themes that arithmetically have to come true, where my risk is when it comes true. I've come to understand the wisdom of Warren Buffett when he said most money is made by sitting, not thinking or acting. And my own strategy is that I would prefer inevitable, even knowing that it doesn't combine often with the words imminent, which is to say, if something has to happen, but it doesn't necessarily have to happen on a timely basis, I've become much more content to sit and wait. It isn't, though, at 73, I have much time left to wait. It doesn't correspond with my time preference, but it does correspond with my experience over 45 years in investing. In other words, whether or not I care to wait, waiting is what is required to make the kind of returns on capital employed that I've come to enjoy.
Yeah, everyone. Sorry for interrupting, but just wanted to say thank you so much for listening. And I hope you're getting amazing value out of this conversation. If you are, we really appreciate it if you could like, share, and subscribe. It really helps the channel and means we can continue to get amazing guests like this one. Thanks again, and let's get back to the show. Yeah, okay, and I guess everyone's trying to, it's the classic Warren Buffett quote, everyone's trying to get rich quick, and he's trying to get rich quick, slowly, and no one wants to do that.
And of course, he did, and they didn't.
Yeah, exactly. So yeah. What's the best strategy there? It makes a lot of sense. So we've talked about copper. What about the precious metals? I guess the silver and the gold, because they've been extremely explosive.
My view on those is unchanged since the last time we talked. I think the incredible move that we saw in 2024, 2025 was rear looking, not forward looking, meaning that the same set of circumstance that was present in 2024 when people took notice was present in 2018 before people took notice. And I think that you had a gold market coming into 2024 that was literally a coiled spring. And I think the price action that we saw in 2024, 2025 was releasing tension from that coiled spring. The spring wasn't all about the lousy arithmetic of US on balance sheet and off balance sheet and other countries' balance sheet problems. The spring also had to do with the weaponization of the US dollar, the stealing of $300 billion worth of Russian assets, irrespective of your belief in what Russia did in the Ukraine, and the weaponization by the US government of the SWIFT banking systems and other places. What this did is create real demand for gold from a source, foreign central banks, that had been until 2015 or 2016 net sellers of gold. That was a big turnaround. And I think that the price action that you saw, the price explosion that we saw in gold in 2024 and 2025, was really backward looking. It was really making up for lost ground. I don't believe that the increases in precious metals prices going forward will be as dramatic as the ones that we've just enjoyed. But I do believe that unless and until the weaponization of the US dollar is discontinued, and until the United States finds a political solution to deficit spending, and until a political accord is reached that eliminates the danger of $120 trillion in unfunded entitlement promises in the United States, and until we have a real interest yield that is above the rate of deterioration of the US dollar, that the value, the purchasing power of the US dollar declines. I believe specifically, as I've said it, as I have said numerous times, that I expect in the period 2025 to 2035, the purchasing power of the US dollar to decline by 75%. There's historical precedent for that. In the decade 1970 to 1980, the purchasing power of the US dollar declined by 75%. And not coincidentally, in that same decade, the gold price ran 26-fold. I'm not suggesting to you, Anthony, that the gold price rises 26-fold from here. It's already done very, very, very well in the period 2000 to 2026. What I am suggesting to you is that gold will maintain its purchasing power over the next 10 years, while the US dollar will lose 75% of its purchasing power, which is to say that the nominal value of gold, the value of gold priced in US dollars, will increase, perhaps commensurately with the decline in purchasing power of the US dollar. Now, people who have a shorter term time frame, people who are more speculatively inclined than I, might not want to look at a gift horse in the mouth. The market, both the gold market and the equities market, precious metals equities market, in 2025 were the third most generous to me in my career. And in fact, had I been younger and more aggressive, the moves that occurred in 2025 would have made it the best year in my life. I was more of an investor in the space than a speculator. And as a consequence of my caution, I did less well than a younger Rick would have. That notwithstanding, the gains were extraordinary. And some people might book those gains. As you may know, I sold 25% of my junior mining stocks in October of 2025. Not because I didn't think that the sector would do well. I've already explained the arithmetic of the next 10 years from my viewpoint, but merely because by selling 25% of my junior holdings, I was able to recoup all of the capital that I had invested in the sector in the period 2018 to 2025, which is to say, by selling 25% of my upside, I eliminated my downside. And by the way, also paid the capital gains tax. Whether or not this technique is suitable for other people is something that is up to them. But I believe that portfolio decisions are personal, and that was mine.
Yeah, okay. It does make a lot of sense. And there's and I'm guessing those sort of miners have done quite well at the start of the year as well as precious metals continue to go up.
Uh, yeah, I mean, ironically, the junior portfolio that I sold a quarter of is back almost to my original levels, which is to say those stocks that I sold have gone up substantially. That doesn't trouble me a bit. Uh, I had rather large investments in the sector, and I still have very large investments in the sector, but I have no net risk in the sector. That to me is an extraordinary trade. It's worthwhile noting that some of the money that I took off the table selling the junior mining stocks went back into the seniors, which I perceived as having less upside but less downside. And some of it went into physical gold, which has done reasonably well. Um, but those weren't really tactical allocations. I was just allocating risk to reward based on the arithmetic I see in markets over the next 10 years.
Yeah, it makes a lot of sense. And then if we go to silver, that was a massive increase over a very short period of time. Would you say that was more driven by mass speculation of the retail investors, or how would you look at that?
Yeah, I would. And again, when we had that parabolic move in silver earlier this year, I decided to take advantage of it. Silver, physical silver in my portfolio, inhabited the speculative part of my portfolio. My own portfolio is divided into three buckets: savings or insurance, which is part gold, part cash; investments, which is high quality mining and oil and gas stocks, as well as some conventional financial services companies, and speculation. And I had purchased a reasonable amount of physical silver some years ago when silver was very widely hated, betting that silver would become less hated, that as the precious metals market continued and the generalist investor came into the precious metals market, that price leadership would change from gold to silver. And both those things occurred. The consequence of that is, given the reasons that I owned the silver had occurred, and given that the price action in silver exceeded my expectations, I needed to decide for myself whether the allocation to silver I had in my speculative portfolio was warranted or not. And I chose to sell about 80% of my physical silver. And I redeployed about half of that into the silver stocks. A simple review of arithmetic told me that if the silver price held steady at $75 for a year, by definition, I wouldn't make any more money in the silver because it traded sideways. But the best silver stocks were being priced in the market discounting $45 silver, which is to say the best silver stocks could easily increase in value, if not in price, by 50% over the ensuing 12 months. And paradoxically, if the silver price went up, I expected the silver stocks to keep pace at least with silver. And if the silver price went down, given the fact that the silver stocks were discounting $45 silver, while the price action might be ugly, the change in value wouldn't be precipitous at all. So it seemed to me, for about 50% of the money that I recovered from selling the silver, that redeploying into the silver stocks was a better, arithmetically, a better speculative decision for me, which is what I did.
Did you see there was sort of a bit of a disconnect between physical silver and paper silver prices? Is that something that you saw as well?
No, I was looking at the valuation discrepancies between the silver stocks and the silver. The silver that I sold was convenient to sell. The silver that I sold was largely the Sprott Physical Silver Trust. So I didn't have to face the on market grind, which is to say the gap between the bid and the ask that you see in the physical silver markets. The actual physical silver that I had in vaults and elsewhere, I still have. Increasingly, to the extent that I trade precious metals, I'm going to trade certificated precious metals. I'm going to trade probably the Sprott products because I know them the best. I understand that some people say metal that you don't have in your hand, you don't own. It's part of the system. That's a risk I'll take because the gap between the bid and the ask in physical markets can be as much as 7%, uh, even for good delivery product, never mind junk silver. But the spread between the bid and the ask on the New York Stock Exchange for the Sprott physical products is often 50 basis points or less. They are much more efficient trading vehicles.
Yeah, okay. Thanks for explaining that. So, last time we spoke, I asked about what do you think is sort of unloved, underrated. You mentioned oil and energy, and that's done quite well since then.
Not much is unloved now. I need to say, not much is unloved. Uh, I mentioned earlier in this interview a little tiny subsector, probably not worth screwing with for most people, which is the microcap conventional explorers offshore in countries that most folks can't pronounce. That's probably not an investment strategy that's suitable for most of your listeners because it requires really pretty complete knowledge of exploration technology and a willingness to accept both volatility and political risk that most people don't have and probably shouldn't have. It's something that I've done for 40 or 45 years. It's something that's made me an awful lot of money in past markets. And as you point out, I gravitate towards hate, and that sector is still hated.
Okay, interesting. So does this mean that you are more cautious when there's not much unloved, or you just sort of watching what you have quite closely?
Looking for opportunities. I have, by my standards, a lot of liquidity. I would like to deploy. I'm just looking at an opportunity constrained world. There isn't very many places to deploy. Most of the new deployments that I have made have been purchasing tranches of the senior secured revolving debt of major mining and oil and gas companies, which means, in effect, I'm a prime lender as opposed to an equity participant in these markets. I would like to be able to take better advantage of volatility and risk, but the size of my existing positions, I'm no billionaire, don't get it wrong, but the size of my existing positions relative to my historical norms and the levels of valuation that I'm seeing, as well as the sentiment, which has swung solidly in favor of natural resources, has made allocations of new capital increasingly difficult for me.
Yeah, okay, really interesting. So, Rick, thanks so much for your time today. We sort of covered basically most commodities and what's happening in the world. But my last question is, what is one message you want people to take away from our conversation?
Love hate. Put arithmetic over narrative if you can make yourself do it, and embrace time. Um, Something that has to happen but doesn't have to happen quickly is much better than something that doesn't have to happen whatsoever. Anthony, if your listeners like what I had to say about natural resources and want to personalize it, I would ask them to go to my website, ruleinvestmentmedia.com. That's ruleinvestmentmedia, all one word.com. There, if you list your natural resource stock portfolio, I personally will rank it 1 to 10, 1 being best, 10 being worst. And I'll offer up individual comments on individual issues if I think my comments might have value. If you want to learn more about how to analyze natural resource stocks, at theruleclassroom.com, we have over 300 hours of instructional programming. And that, like the ranking service, is completely free, which is a very, very, very good price. Finally, if you really want to learn more, there's the Rule Natural Resources Investment Symposium held July 6 through 10 in Boca Raton, Florida, or more importantly, via live stream wherever you happen to be. The live conference is completely sold out. We have no seats available. Live stream, our capacity is unlimited. If you attend the conference, there is 46 hours of instructional programming over 4 days. There is mercifully recordings because we'll give you more information than you can absorb in the 4 days that you have to gather it. And unlike any other investment conference in the planet, if for any reason you don't think you got your money's worth for that 4 days, we will refund without question the money that you paid us to attend. Ruleinvestmentsymposium.com, live stream, July 6 through 10, wherever you happen to be, with access to the recordings of the conference for the balance of 2026.
Yeah, great, perfect. I'll put that all in the description below, and I'd very much recommend if anyone wants to find out more to check it out. But Rick, thanks again for your time.
A pleasure. Thank you.
Hey everyone, thank you so much for listening. Really appreciate your support, and I hope you found amazing value out of this interview. If you really enjoyed it, would appreciate if you liked and subscribe or share. It really helps with the podcast. We're still trying to expand, get to more people to help make sure that everyone understands and decode what's really happening in the world of finance, investing, macroeconomics, and geopolitics. If you enjoyed this one, then you might enjoy this other interview as well. So really appreciate it, and thank you.